Hello students, a warm welcome to all of them. I hope you all are doing good and fine. In our today's session, we will be starting with the chapter number 8, Capital Allowance. As we have come across this term in our previous chapters, that is property income, employment income and income from self-employment. In our today's session, we will be studying capital allowance in detail. So before starting our today's session, let's understand what does the term capital allowance means. So students, when we prepare our accounting books, we calculate depreciation. Depreciation as per IAS 16. Why do we calculate depreciation? We calculate depreciation because as we use our asset in our business, the value of the asset falls. So we calculate depreciation, and depreciation will be treated as an expense under the accounting books. I hope this point is clear. And students, we have already seen in our previous chapter, when we calculate our tax adjusted trading profit, depreciation is disallowed. So we need to add back to the accounting profits so that we arrive to a tax adjusted trading profit. Depreciation is disallowed, then what will be allowed? Capital allowance will be allowed. And capital allowance is the form of depreciation under the tax rules. Because depreciation is disallowed, HMRC says that capital allowance will be allowed. What does capital allowance means? Capital allowance is a form of depreciation. It will also take into consideration the fall in value of the asset under the tax rules. So capital allowance will be allowed and depreciation will be disallowed. So I hope the term capital allowance is clear. Now we will be seeing the chapter learning objectives. What all will be covering under this chapter? Define plant and machinery for capital allowances, definition of plant and machinery, compute writing down allowances, first year allowances and the annual investment allowance. These are the three types of allowances which we can claim on an asset. WDA, first year allowance, and AIA, annual investment allowance, FYA and WDA. Compute capital allowances for cars. Compute balancing allowance and balancing charge. These two are balancing adjustments. Compute structure and building allowances. As we have seen this term under a property income, FHL, furnished holiday letting, we have seen that the FHL will qualify for structure and building allowances. Recognize the treatment of short life assets. The assets which have short life, how we will be calculating the capital allowance, and the assets which are of special nature, how we will be calculating the capital allowances. In this chapter, we will be covering these 7 topics. As we cover these topics, you will have a good idea what will be tested in your examination. Now, this is the flow chart what we will be covering under this chapter. Plant and machinery. Why plant and machinery, students? Because capital allowance will be available on plant and machinery. Definition. Special assets include cars, short life assets, integral features and long life assets, and private use assets. Allowances we have already seen. AIA, annual investment allowance, FIA, first year allowance, WDA, writing down allowance, and we will be seeing a small pool allowance under the writing down allowance, and balancing adjustment means balancing allowance and balancing charge. And we will be covering the structure and building allowances which will be available for buildings, as buildings will not qualify for capital allowances. It will be applicable, the capital allowance will be applicable on building, but we will be calculating the structure and building allowances. We have a different topic. We will be seeing the qualifying expenditure, writing down allowance and disposal. Now, capital allowances are provided to give a business tax relief for capital expenditure on qualifying assets. Capital allowance is provided to provide tax relief on capital expenditure. As we have already seen, students, in a previous chapter, capital allowance will be disallowed. So, to claim tax relief on the capital expenditure, we need to calculate capital allowances. And capital allowance is calculated on qualifying assets, only on qualifying assets. Remember that depreciation charged in the accounts is not allowable in computing tax adjusted trading profit. Capital allowances are given instead. We have covered this in a previous chapter. That is, depreciation will be disallowed, but capital allowance will be allowed. Capital allowance are available to persons who buy qualifying assets. So capital allowance will be available on qualifying assets. Qualifying assets means plant and machinery for use in trade or profession. So the plant and machinery must be used in trade or profession. Then only capital allowance will be claimed. Capital allowance are available to both sole traders and companies. So capital allowance is available for individuals also and companies also. However, there are some special rules for calculating capital allowances for companies, which are covered in chapter number 13. We will be seeing under chapter number 13, the capital allowance for companies. In our today's session, we will be seeing the capital allowance for sole traders. In the tax examination, however, capital allowance are not available to unincorporated business that uses the cash basis. So students, capital allowance will not be available to unincorporated business which uses the cash basis. I hope these 5 points are clear. This gives a basic understanding of this chapter. Now, moving to qualifying expenditure. Qualifying expenditure includes plant and machinery used for trade or profession. Capital allowance are given on the original cost of the capital asset. So capital allowance is given on the original cost of the capital asset and all subsequent qualifying expenditure of capital nature. So students, capital allowance will be provided on the original cost of the purchase of the capital asset, and if we are incurring further expenditure which are of capital nature, then it will also qualify for capital allowances. As we have already seen the difference between capital nature and revenue nature. Revenue nature will not increase the earning capacity, but it will maintain the earning capacity. Capital nature, it will increase the earning capacity. I hope this is clear. Now, relief for capital allowance. Capital allowances are an allowable deduction in calculating the tax adjusted trading profit. When we calculate a tax adjusted trading profit, students, depreciation is disallowed and capital allowance is available. Now students, this capital allowance is calculated for traders' period of account. What does period of account mean, students? Period of accounts means accounting period. The accounting books are prepared, that is from Jan to December or April to March or November to December. It is upon the trader's choice, but our tax year starts from 6th April to 5th April. But we calculate capital allowance on period of accounts, that is accounting period. Now students, we will be seeing the definition of plant and machinery. Machinery has a commonly understood meaning. It includes all machines, computers and office equipment. So students, as we are already familiar with the word machinery, we can be able to identify what does the term machinery means. But when coming to the term of plant, the term plant, however, is not clearly defined in the tax legislation. HMRC has, however, codified some rules based on decided court cases and has specifically deemed certain types of expenditures to be plant and machinery. So the term plant is not clearly defined in the legislation, but HMRC has codified some rules based on previous case laws. They have given some principles and they have specified that some of the expenditure will deem to be plant and machinery even if they do not meet the specific rules. Coming to the specific rule, key principles. The key principle to apply in deciding the appropriate treatment of a capital purchase is to consider the function that asset performs for the business. So students, to decide whether the asset is plant and machinery, we need to see what is the function of the asset for the business. What function does the asset performs for the business? If the asset performs an active function, it will be plant and machinery. If the asset performs a passive function, it will not be a plant and machinery. Active function. So students, what does active function means? Active function means with the help of the plant only we are able to run the business. If the plant is not available, we will not be able to the business. So active function means the asset must be actively involved in the business to carry out the business. If the asset is not available, the asset which will qualify plant or machinery will not be available, then it will be passive. See students, it is opposite. Active means which is actively involved in the running of the business. Passive means it is not actively involved, but it will help the business. But when coming to the active function, it will be actively involved in doing the business. So these you need to have a general understanding, students. Active means which is actively involved, which helps to carry out the business. If the asset is not available, we are not able to carry out the business. So then that type of asset will be classified as plant and machinery. If the asset performs a passive function, the setting in which the business is carried on will not qualify for plant and machinery. Apparatus with which the business is carried on. Apparatus means equipment or technical machines. Apparatus means equipment, that is asset through which we carry out our business. Assets deemed to be plant. If we have seen the special rule, the key principles to determine whether the asset is plant or machinery. But HMRC has specifically deemed certain types of expenditure to be plant and machinery. There are certain types of expenditure that although not planned using the above key principles are treated as planned by specific legislation. These include the cost of alteration to buildings needed for the installation of plant. We have incurred and cost for alteration of the building such that the plant or the asset gets into fit or we can install it. For installation purpose of the machinery, we are incurring an cost to alter the building and expenditure on acquiring computer software. I hope these 2 points are clear, students. The assets which are specifically deemed to be classed as plant and machinery are the cost of alteration to buildings needed for the installation of plant and expenditure on acquiring computer software. Assets deemed not to be plant. Statute also makes it clear that land, building and structures cannot be planned for capital allowance purpose. There is a separate allowance available for qualifying buildings and structures. Detail will be studying further. So students, building, land and structures are not planned, but these will qualify for a separate allowance known as structure and building allowances. I hope this is clear. Summary: determining what is and what is not planned can be difficult in practice. In the examination, the most common examples of plant and machinery are computers and software, machinery, cars and lorries, office furnitures, movable partitions, air conditioning, alteration of building needed to install plant and machinery. So these are the few examples of plant and machinery which will be tested in a examination. I hope this is clear. Now, we will be seeing the format for capital allowances. Capital allowance format. As we have seen, students, capital allowance, students, we have already seen that the capital allowance is available on Students, we have already seen that capital allowance, is available on qualifying expenditure. Qualifying expenditure. I hope this is clear, students. Capital allowance will be available on qualifying expenditure, and we have already seen it. Qualifying expenditure means plant and machinery. Plant and machinery that must be used for trade or profession. I hope this point is clear. Capital allowance are available on qualifying expenditure. Qualifying expenditure means plant and machinery which are used for trade or profession purpose. Now students, coming to the format of capital allowance. So students, the assets which we have purchased, the assets, that is qualifying expenditure, the assets plant and machinery, these plant and machinery we need to divide these into 4 pools, that is main pool, special rate pool, and short life asset and private use asset pool. So students, these are the 2 main pools in our course. These 2 also will be studying, but these 2 pools are main. When coming to short life asset and private use assets, these assets which are included in these pools will also qualify for main pool and special rate pool, but they fall under the some specific conditions. So we will be calculating the capital allowance for assets which are of short life and the assets which are privately used under a different column. I hope this is clear. Now students, the expenditure, qualifying expenditure, we need to allocate to these pools. If the qualifying expenditure is in main pool, okay. Special rate pool, we need to qualify under special rate pool. If short life asset, under short life asset. Private use means it will be under the head of private asset. After this students, the format of the capital allowance will start. First, we need to decide the qualifying expenditure falls under which pool. Either main pool, special rate pool, or short life asset or private use asset. I hope this is clear. Now students, the format starts from tax written down value brought forward. Tax written down value means students, previous year we would have calculated the capital allowance and we had some balance. The balance we are bringing it back. The balance we brought it forward. So tax written down value. Tax written down value means cost of the asset less the capital allowance we have claimed will give rise to the written down value. The value after claiming the capital allowance will be the written down value. So this written down value will be always given in the figure, students, in the examination. The capital allowance figure will be always given in the examination. This will always be given in the examination. We need to allocate it to the pool as per previous year calculation. Then if we purchase any additions, if we purchase any new asset for that year, will be stated as addition, and if we dispose, will be treated as disposal. So additions, now we have seen that students, we have 3 types of capital allowance: AIA, FIA and WDA. These 3 will be available for all the assets. Either AIA will be available or 3, or FIA will be available, AIA, WDA will not be available. So we'll be seeing depending upon the type of asset. But now coming to main pool, special rate pool and short life, and this first will be seeing whether the capital asset follows under which pool. Now we will be seeing the allowance part, whether the addition which we have purchased qualify for AIA or FIA or WDA. If the addition qualifies for FIA and AIA, the whole amount will be allowance. And then disposal. Then before the disposal, additions not qualifying for AIA will directly straight to the pool. Disposal, after the disposal, we'll be getting a figure. On this figure, we'll be calculating the WDA. This transfer to main or special pool will be covering further. This will come under the case of short life asset. Then the amount, the balance amount will be calculating the WDA. See students, the brought forward value plus any additional plus disposal, this is the value of the asset. So on this we'll be calculating the WDA, and then the rest part will be the tax written down carry forward for the next year, and this column will be using for the allowance part. Whatever allowance we claim will be writing here, and this allowance part we will be using under the tax adjusted trading profit. I hope this is clear. The format is clear. As we'll be doing many questions, the format will be clear. Only whenever you start the format, first you need to see whether the asset falls under which pool, special rate, main pool, or private or short life asset pool. Then we need to see whether any balance is brought forward or not. It will be specified in the question. Then we need to see whether we have any addition in that year or not. After that, students will see whether the additions qualify for AIA or FIA. Then we'll treat as per the AIA and FIA rule. If the asset does not qualify for AIA and FIA, we'll directly write the amount under the main pool or special pool which the asset belongs. Then we'll see whether any disposals are there. If there are disposal, we'll reduce the value, and after the disposal, we'll calculate the tax, the written down allowances. I hope this is clear, student. The format is clear. Now we'll be looking in more detail to the AIA, FIA, WDA, and main pool. If you are clear with main pool, then special rate pool, short life asset pool, and private asset will be very easy. Only you need to understand the rules for AIA, FIA, and WDA. Now we will be covering the rules for AIA. What does AIA, what does FIA means, what does WDA and main pool, special rate pool, short life asset, the private use asset means. In this format, students, whatever you see, we'll be studying these one by one. Main pool or general pool. Either it will be main or general pool. So students, capital allowance is available on qualifying expenditure, and when we are calculating qualifying expenditure, we need to see whether the expenditure is plant and machinery, and if plant and machinery, we need to decide whether this will fall under which category: main pool, special pool, private asset pool, or short life asset pool. After this, we will be seeing the rules, how we will calculate the capital allowances. General pool. Generally, expenditure on plant and machinery becomes part of a pool of expenditure upon which capital allowance are claimed. So, generally, expenditure on plant and machinery becomes part of the pool of expenditure upon which capital allowance are claimed. Normally, capital allowance are not calculated on individual assets. We need to do a business and we need to have many assets so that we can calculate capital allowances. Most items of plant and machinery purchased are included within the main pool, as known as general pool. So most of the plant and machinery will be under the head of main pool, but some certain assets will be dealing under the special rate pool or private asset pool or short life asset pool. We'll be covering in more detail. Now coming, students, we have already seen that capital allowance on car also can be claimed, but under the general pool, all cars with CO2 emission between 1 gram per kilometer and 50 gram per kilometer are included. So under the main pool, all cars with CO2 emission between 1 gram per kilometer and 50 gram per kilometer are included in the main pool. Second hand cars with zero CO2 emission are included in the main pool. Now we are only just classifying the assets under which category which asset will come, and then we'll be looking to the AIA, FIA and WDA. So I hope this is clear. This is general pool. General pool means all items which are qualifying expenditure, that is plant and machinery, will fall under the general pool. But if certain conditions are satisfied, then it will fall under the special rate pool, private use asset or short life asset pool. And cars, when coming to the case of cars, CO2 emissions of cars between 1 gram per kilometer to 50 gram per kilometer will follow under the head of main pool. And second hand cars with zero CO2 emission will also fall under the head of main pool. When asset is acquired, the purchase price increases the value of the pool. See students, we have already seen in our format brought forward balance and any addition. If we add any addition, the value of the pool will increase. So this is the point. And if we dispose, the value of the pool. If we dispose, the value of the pool will reduce, on which the WDA will be calculated. When an asset is disposed of, the pool value is reduced by the lower of sale proceeds and original cost. I hope this is clear. We have seen what are the items relating to main pool. Main pool, all general items will be included. If they are not included in special rate pool, short life asset and private use asset. If the assets are not pertaining to these three pools, all the assets will be included in the main pool. If these three pools, the asset does not satisfy these three pools condition, then it will be automatically under the main pool. And in main pool, we have seen under the case of cars with CO2 emission, students, and cars with CO2 emission of 1 gram per kilometer and 50 gram per kilometer, between this range will come under the main pool. And second hand cars and students, second hand cars with zero CO2 emission will also come under the main pool. Now we have seen the main pool items. Now we will be seeing how to calculate the capital allowance. As we have seen, three types of capital allowance are available: AIA, FIA and WDA. These are the allowances which we can claim on the asset qualifying expenditure. Certain items that are not included in the main pool, as we have already seen: expenditure incurred on short life asset, expenditure incurred on items that form part of the special rate pool. If the asset belongs to special rate pool, no. Short life asset pool, no. Main pool will be available, because these assets will be treated as per these pools. It will not come under the head of main pool. And assets that are used privately for private use by the owner of the business. I hope these are clear. These three things are clear. Now, students, we have seen here all cars with CO2 emission between 1 gram per kilometer and 50 gram per kilometer will be included under the main pool. But if it is above 50 gram, it will come under special rate pool. We'll be covering that in detail. So new or second hand cars with CO2 emission in excess of 50 gram per kilometer will not be treated under main pool. And new zero CO2 emission cars will also not be treated under the main pool. As we have seen here, students, only second handed cars, second hand cars with zero CO2 emission will be under the general pool. But if new zero CO2 car, zero CO2 emission cars, it will be covered under different head. We'll be seeing it in more detail. Now coming to the AIA, annual investment allowance. What does AIA means? AIA, we have already seen, it is an allowance. It is on investment and it is calculated annually. Capital allowance, we have three types of allowance: AIA, FIA and WDA. And AIA means allowance which is provided on the investments and it is provided annually. I hope this is clear. Now the annual investment allowance. So students, first we First, we assess whether the asset will fall under the main pool, special rate pool, or short life asset, or private asset. After that, we will calculate the allowance. After that, we will calculate the allowance. Now, how we will calculate the allowance? First, we need to see any additions which we are doing in the current year. Any additions which we are doing to the current year qualifies for AIA or FIA. If they qualify for AIA, the whole amount we will take as allowance. Now we will be seeing the amount. The annual investment allowance AIA is a 100% allowance for the first 1 million pound of expenditure incurred by a business in a 12-month period on plant and machinery. So AIA is only available on plant and machinery. The maximum 1 million pound is available on the expenditure incurred by an organization in 12 months period of accounts. For 12 months period. So this 1 million students is for 12 months. This AIA will be available. The key rules for allowance are as follows. Available to all businesses. AIA is available to all businesses. Available on acquisition of plant and machinery in the main pool and acquisition of special rate pool. So AIA is available on plant and machinery in main pool and special rate pool. Not available on cars. So AIA is not available on cars. Limited to a maximum of 1 million pound expenditure incurred in each 12-month period of account. So students, for each 12 months period of accounts, we have 1 million pound as the AIA. So Jan to December I prepare my period of account. So for this period 12 months, the AIA will be 1 million pounds. And for next year from Jan to December, again 12 months, you have 1 million pound annual AIA. Why HMRC provide this AIA? Because if this is provided, businesses will invest more money in machinery so that they expand their business and the economy is good. The economy of the country will increase. So the annual investment allowance will be provided. And we have seen the rules. Annual investment is available to all businesses. Is available on plant and machinery which are purchased additions for main pool and special rate pool items. AIA is not available on cars. AIA is not available on cars. Limit, the maximum limit is 1 million pounds for each 12 months accounting period. And for long and short period of accounts, the maximum allowance is increased or reduced to reflect the length of period of accounts. So students, let's take an example. I prepare my books of accounts for 8 months. That is from Jan to October. So the accounting period is only for 8 months, but this is 1 million pound for 12 months. We need to reduce it. If it is accounting period is more than 14 months, we need to increase it. If it is less, we need to adjust it. We need to adjust the annual allowance as per the period of accounts. Not available in the period of accounts in which the trade ceases. So students, the AIA, the annual investment allowance of 1 million pound will not be available in the period of account in which we cease our trade. The period of account in which we cease our trade, the AIA will not be allowable. So these are the 5 important points you need to keep in mind, students. The limit is available for 12 months, not available for cars, and we need to increase or reduce as per the period of accounts, and the AIA will not be available in the period of accounts in which we cease to trade. Where a business spends more than 1 million pound in a 12 months period of accounts on a asset qualifying for AIA, the expenditure above 1 million pound limit qualifies for WDA. So students, if I purchase an asset, let's take this is an asset we have purchased. First we'll claim the AIA. We'll calculate and claim AIA. If the AIA limit has been used, that is 1 million pounds. If we have purchased more than 1 million pound, the excess amount will be eligible for WDA. WDA means writing down allowances. So the writing down allowance will be available for the excess amount of more than 1 million pound. Note also that Taxpayer do not have to claim all or any of the AIA if they do not want to. We can either claim the AIA half or full or of any percentage. Any unused AIA cannot be carried forward or carried back. The benefit of the allowance is just lost. So students, the AIA which is available of £1 million for each 12-month accounting period, if we use only 80%, the 200,000 left we can't carry forward or carry back. I hope this is clear. The maximum amount of AIA, that is 1 million, is included in the tax rate and allowance provided to you in the examination. This will be provided. Now students, when we use the AIA, we need to follow this order. First, the AIA will be allocated to special rate pool items, main pool, short life pool and private use pool. Why? First, the AIA will be allocated to special rate pool, students, because the WDA is of 6%. WDA means writing down allowance. Every year you can write down the allowance by 6%, but when coming to main pool, you can write down 12%. We'll be studying this first percentage also. So why we take the format of special rate pool first? Because the writing down allowance percentage is low. The percentage is low means we will be claiming the allowance value low, but when coming to main pool, it is 12%, or we will be using it, the allowance will be more. So if we use the annual investment allowance for special rate pool first, then we can claim more allowance on the main pool at 18%, not 12%, students. It was just an example. The exact rate is 18%. We'll be seeing, no issues, 18 and 6%. Then short life pool, then private use pool. So I hope this is clear. The AIA, as we have seen under the format of additions qualifying for FIA and AIA. If AIA they qualify, the AI qualification, this is a type of allowance. The limit we can claim in 12 months accounting period, 12 months accounting period, 12 months accounting period, students, is £1 million. We can claim the allowance. Further, we have invested more, then it will qualify for WDA, and the excess amount will be written in the main pool. Then we will see the additions qualifying for FIA. So now students, now we will be seeing the FIA, first year allowances. Students, this first year allowance is only provided to new zero emission cars. First year allowance is provided to new zero emission cars. As we have seen that under the main pool, second hand cars with zero CO2 emission qualifies, but new cars with zero CO2 emission will qualify for first year allowances. The AIA is not available on cars. However, a 100% first year allowance is available on the purchase of new zero CO2 emission cars. So students, we have seen that the AIA, the annual investment allowance, will not be available. It will be directly written in the pool. Under the main pool, we have 1 gram per kilometer to 50 gram and second hand car of CO2 emission, zero CO2 emission. But if we purchase a new zero CO2 emission cars, it will qualify for first year of allowance, that is 100% of the value of the car. The 100% FIA is given as follows. In the period of acquisition, a 100% FIA is given instead of WDA. So students, in the period of acquisition, 100% FIA is given instead of the WDA. That is, business cannot have both FIA and also any WDA in the first year. Now students, we purchased a car, that is new zero CO2 emission. This will qualify for 100% first year allowance and we will claim it whole amount, because this will reduce our taxable profit. So, but if a person partially uses the FIA and then uses the WDA, we have some different rule. We will be covering further in this slide only. So in the period of acquisition, 100% FIA is given instead of the WDA. A business cannot have both FIA and also any WDA in first year. So if you claim FIA, you can't claim WDA in the same year. You can claim WDA from next year. Unlike the AIA and WDA, the FIA is never time apportioned for period of accounts greater or less than 12 months. So AIA we were adjusting as per the accounting period. But when coming to FIA, will not adjust it because students, we are providing on the value of the asset. We are providing on the whole value of the asset. Zero CO2 car emission, 100% will be available. If you purchase 1, 2, 3, if you purchase 3, on 3 also you can claim 100%. But when coming to the AIA, we had a limit amount. The taxpayer does not have to utilize all or any of the AIA. If FIA is not used at all, WDA will be available. However, if the FIA is only partially used, the balance of the cost goes into the main pool but is not entitled to any other allowance in that first year. So students, as we have seen here, the FIA will be available for new zero CO2 emission cars, new cars. So whole amount means no issues. If we are only claiming the FIA at 80%, that is 80%, but HMRC is providing 100%, we are only claiming 80%, and then we calculate WDA. But students, we have a limitation. Either you can use the full AIA 100% or either you can use WDA. Use full or follow WDA. If not, FIA 80% and on the rest 20% you calculate WDA. When the rest amount on which FIA is not calculated, the cost goes into the main pool but not entitled to any other allowance in that first year. So let's take an example. Jan to December, I purchase a new zero CO2 emission cars. I can claim 100% FIA, but I claimed only 80%. This 20% will be eligible for WDA, but I can't calculate the WDA in this year. I can calculate the WDA for next year. I hope this is clear, students. The FIA will not be time apportioned as per the accounting period, but FIA will be available and WDA will also be available. If FIA is available, we can claim 100%. If we partially claim the FIA, then the rest cost will go to the main pool but will not be entitled to any other allowance in that first year. Only in this year, only the first year in which we partially use the FIA. From other years, you can calculate the WDA. FIAs are not given in the final period of trading. Same as AIA, FIA will also not be available in the period of accounts in which we seize our business. If the zero CO2 emission car is not new, second hand, it is treated in the same way as a car with CO2 emission of between 1 to 50 grams per kilometers, that is under the main pool. So the cost is added to the main pool and no FIA or AIA is available. As we already seen, students, AIA will not be available for any cars. No AIA. For cars, no AIA. But FIA will be available only for zero CO2 emission cars. But when coming to second hand cars, zero CO2 emission second hand cars, it will come under the main pool. But when it comes to the main pool also, AIA will not be available, only WDA will be available. I hope this is clear. Now students, now we'll be looking to an example relating to AIA. Annual investment allowance. Question number 1. M commenced trading on 1st Jan 2024. In his first year of trading, he made the following purchase. So this is his first year of trading, students. This is his first year of trading. Plant and machinery costing 1,60,000 pounds were purchased. Office and furniture equipment of 170,000 were purchased, and a new car with CO2 emission of 45 gram per kilometer for the use of his manager of 11,000 was purchased. Calculate MAIA for the year ended 31st December 2024 and the balance on the main pool after deducting the AIA. Prepare the same calculation but this time assuming M did not purchase the plant and machinery. So here students, we need to calculate the capital allowance. So how do we start the capital allowance? It was available on qualifying expenditure, that is plant and machinery, and which are used for the business purpose. So we need to see the asset which falls in which pool. First we need to segregate the assets in which pool does it follow. Main pool, special pool, and private use pool, short life asset pool. As we have just started with the main pool, this question relates to main pool only. This pool will not have any assets. This will be allowance column. See here students, this is the format: FIA, main pool, special rate pool, short life and private use pool. FIA and AIA. Now students, all general item will fall under the main pool. So all will, this plant and machinery, office furnitures and equipment will fall under the main pool. And a new car with CO2 emission of 45, as this is within the range of 1 gram per kilometer and 45 gram per kilometer, will fall under the main pool. So now we have already seen the assets in which pool it will fall. Now we need to see whether any balance is brought down, tax written down value. As our format starts students, from tax written down value, as M is commenced trading on 1st January, so no tax written down value will be there. After tax written down value, additions, any additions we have purchased plant and machinery, we need to see additions qualifying for FIA and AIA. So here students, FIA additions will be available or not? Not, it will not be available. Because students, FIA is only available on new zero CO2 emission cars. So the tax written down value brought forward will be, for each asset, each pool, it will be different students. You need to see it. Now as we are starting this year, we do not have any value brought forward. Additions qualifying for FIA and AIA, we do not have anything. So for AIA, the AIA will be available for all pools, that is special rate pool, main pool, private asset pool and short life asset pool. But first we need to allocate to the special rate pool, but no special rate pool is available. We'll allocate to the main pool, that is plant and machinery of 1,60,000 pounds and office and equipment for 170,000 pounds. So these two will qualify for AIA. So AIA will qualify for, that is plant and machinery and office furniture and equipment, that is 1,60,000 pounds, and office furniture equipment is 170,000 pounds. So this is the total which qualifies for FIA or AIA. There is AIA, FIA only on zero CO2 emission. So AIA, the amount which qualifies is 1,230,000 pounds. But students, the annual allowance limit is, which we can claim for 12 months accounting period is 1 million pound, and we have already seen the accounting period is from Jan to December, so it is for 12 months, so no need to increase it. See here students, we have not included your car because on car AIA is not available. So the AIA FIA column, so 1 million pounds will be an allowance, so it will be written down here in our allowance column. I hope this is clear students. Now students, additions not qualifying for AIA and FIA. So we have seen the addition of this is, students, 230 will not qualify, this will qualify, but the excess will be transferred to, see here students, the excess will be, on the excess we can calculate WDA, so the excess will transfer to the main pool as these assets relates to the main pool. Now additions which do not qualify for FIA, these are car of CO2 emission of 42 grams, this will be under the head of main pool. So students, any disposal? No disposal. So no disposal, students. No disposal. Then we need to calculate the WDA. Still we have not covered the WDA. We'll be covering and solving it further. But what does the question states here? The question states, calculate MAIA for the year ended and the balance on the main pool after deducting. So balance in the main pool will be, students, here. So the balance will be 230 plus 170,000 pounds. So 230,000 plus 170,000, the balance will be 230 plus 170 will be no students, sorry, mistake, this is 11,000, this is 11,000 pounds. So it will be the balance of the main pool will be 241,000. On this will be calculating the WDA. So we have seen the first question. Now prepare the same calculation, but this time assuming M did not purchase the plant and machinery. So M only purchased office furniture, equipment and CO2 emission. So they purchased only 2 items. So coming to the case number B. So B, FYA, AIA, main pool, no special pool, private asset pool, short life asset pool and allowance column. So here students, tax written down value, no, 0, because he is starting his trade from 1st Jan and it is this year he has started his trade. Then additions qualifying for FIA and AIA. As we have seen in a question number B, that students, M did not purchase the plant, only these 2 items were purchased, CO2 emission car and furniture equipment. So the furniture equipment for office will qualify for AIA. So this will be office furnitures and equipment, 1,70,000. So the limit of AIA is, students, 1 million pound and this is within the limit. So AIA will be available of full amount. So in the allowance column we'll write 170,000 allowance and excess, no excess. Now addition qualifying for FIA, no FIA as the car is CO2 emission. Now additions not qualifying for FIA and AIA, that is car of CO2 emission will be under the main pool because it is between the range of 1 gram to 50 gram per kilometer. And now students, any disposal, no disposal. So this will be the value, this will be the value. So on this value we will be calculating the WDA. See students, the AI is a allowance, it is a type of capital allowance, FIA is also a type of capital allowance and WDA is also a type of capital allowance. So these are the 3 types of capital allowance which will give rise to the total of this allowance column, and this total we will be using to adjust our tax adjusted trading profit. So students, in this case the main pool balance will be 100,000, that is 11,000, sorry, and in this it will be 241,000. I hope this is clear. Now we have seen the annual investment allowance and we have seen the FIA. Annual investment allowance, the limit is 1 million pound and it is for each 12-month accounting period on plant and machinery, and if the period of account is long or shorter we need to adjust the 1 million pound. If it is shorter, the 1 million pound will reduce. If it is longer period of accounts, the 1 million pound will increase. And Students, the AIA will not be available in the period of account in which we cease our trade, and the annual allowance will be available in the order of special rate pool first, main pool, then short life pool and private use pool. And the excess of the limit of 1 million will be treated as WDA. It will qualify for WDA, and we need to write the figure in the main pool. Why, students? Because after the addition less disposal, the value will result, and on this value we will be calculating the WDA. And the FIA is available on new zero CO2 emission cars, that is 100%. And if we partially claim the FIA, we can't claim the WDA in that year, but in the next year we can claim it. In the next year we can claim it. So students, if we were able to claim here, students, if we were able to claim here only 80% of FIA, then the 20% will be eligible for WDA, but in that year will not calculate it. So the additions not qualifying for FIA will be written here down, so that we do not calculate the WDA. Because if we partially calculate the FIA, on the partial amount FIA will be available, but on the rest amount WDA will not be available in that first year. From next year we can calculate the WDA, and FIA will not be reduced proportionally as per the accounting period, because it is provided on the value of the car. Now students, now we will be doing WDA, written down allowances, written down or writing down allowances. An annual WDA of 18% is given on a reducing balance basis in the main pool. So WDA is given at 18% on a reducing balance basis in the main pool. Reducing balance basis means, students, written down value plus additions less disposals. This is the value on which we will be calculating WDA. This is same as the depreciation, because capital allowance is a form of depreciation, and in depreciation, students, we have straight line method and written down value method. So the written down value we had some percentage, the same applies here. I hope this is clear. An annual WDA of 18% is given on reducing balance basis in the main pool. It is given on the unrelieved expenditure in the main pool brought forward at the beginning of the period of account. So the beginning of the period of account we brought this forward, on this it is given. Any addition on which the AIA or FIA is not applicable, AIA and FIA is not applicable. If AIA and FIA is applicable, this is an allowance, we have already taken it. If any excess amount or on which AIA and FIA is not available, on that WDA will be available. Plus any additions not covered by the AIA, that is exceeding the limit which we have exceeded. Any addition on which FIA is not available, like car CO2 emission of 1 gram per kilometer to 50 gram per kilometer, and any addition not covered by the AIA limit of 1 million pound after taking account of the disposal. So this, student, is important, that is written down value, tax written down value plus addition less disposal, then we'll be getting the reducing value. On this we will be calculating the WDA. On this value we will be calculating WDA after taking account the disposal, any addition not covered by the AIA. So the WDA will be provided on the additions which are not qualifying for FIA purpose, not qualifying for FIA and AI, because these are the type of allowance we have already claimed it. We can't further claim written down allowance, we already claimed the allowance. See, we have seen in our example number 1, students, we have claimed the AIA of 1 million, this is the limit, and on this we are calculating the WDA because this has exceeded the limit. The tax written down value brought forward includes all prior year expenditure added to the main pool less allowances already claimed. So what was the cost? Less prior year allowances claimed, less allowances already claimed. This will give rise to the tax written down value brought forward. So cost less the allowance we have already claimed give rise to the tax written down value. The 18% WDA is included in the tax rates and allowances provided to you in the examination. So students, the percentage rate will be provided in the examination in the tax rate and sheet. Now coming to computation. In the tax examination, you will normally do computation for one period of accounts only. In the tax examination, only one period of account. But when we are practicing our today's question, we will be doing for multiple accounting periods so that we have a better understanding of this topic. In all questions, you should assume that tax year 23-24 applies throughout. This is only for calculation. But in your tax examination, the written down value will be provided and you need to calculate only for one period of accounts. Now coming students to an example. So that we will be covering the FIA, WDA and AIA. Question number 2. A commenced trading on 1st January 2024. Her trading profits adjusted for tax purpose but before capital allowance are as follows. Year ended 31st 2024 is this amount. I hope this is clear. Year ended 31st December 2021 is this profit before the adjustment of tax adjusted trading profit. On 9th May, so students, on 9th May 2024, she bought plant and machinery for 1,250,000 pounds, a second-hand car with CO2 emission of 43 grams for 6,500 pounds and a new zero emission car for 13,600 pounds. Calculate G tax adjusted trading profit for both years, that is 31st December 24 and 31st December 25. Assume that tax year 23-24 rules applies throughout. Now students, first we will be seeing whether the assets fall in which pool. Plant and machinery, normal, so main pool. Second hand car with zero CO2 emission of 43 grams per kilometer, students. 43 grams per kilometer, it will be main pool. It will be main pool. And a new zero emission car for, so FIA will be available on this. Now we need to calculate the tax adjusted trading profit for both the years. For both the year, students. So let's start the solution. So for tax adjusted trading profit will be the trading profit less capital allowance. So for the year 24, December 24 and December 25. We are calculating for the accounting period here, students, not for the tax year. We'll be seeing how to calculate for tax. We have already covered in this chapter number 7 how to calculate for the tax year. Now the trading profit is 1,520,770 and here 1,525,000 pounds less capital. Now we need to calculate the capital allowance for 24. And students, one point you need to keep in mind, capital allowance is calculated period of accounts, not tax year. We calculate period of account. Period of account means accounting period. I hope it is clear. Now the accounting period is Jan to December, Jan to December. I hope this is clear. Now we will be seeing the capital allowances. Capital allowance. Now students, FYA, AIA, the main pool, special pool, private pool, short life asset pool and allowance column. First we need to start with tax written down value brought forward. But here students, they commence trading on 1st Jan 2024. I hope this is clear. So we will not have any tax written down value. Now we need to see any additions. Additions are there. They bought on May. She bought plant and machinery for this amount and a second. So we will see additions qualifying for FIA and AIA. So students, now additions qualifying for FIA. Do we have here? Yes students. For new zero emission cars, it will qualify for FIA, that is 13,600. So 13,600 full 100%. So it will be FIA of 13,600 allowance. Now coming to AIA, AIA will be on plant and machinery. AIA we can't claim on the car students. We can't claim on the car. So AIA qualifying expenditure for AIA plant and machinery, that is qualifies as 1,025,000 pounds. And students, what is the limit here? The limit is only 1 million pounds. So the excess, on the excess will calculate the WDA. How will calculate the WDA students? WDA will be calculated brought forward balance plus additions which do not qualify for AIA, additions which qualify AIA but exceeds the limit. So exceeds the limit here is 250,000 pounds. Now additions not qualifying for AIA, that is car students. We have seen the car of CO2 emission of students 43, it will be in the main pool. So the cost is 6,500. I hope this is clear. Now any disposal students? No disposal. Less any disposal? No disposal. This we will get the value. By this we will get the value students. We will get the value. The balance will be now 250 plus 6,500. It will be 256,500 pounds. I hope this is clear. Now on this value we will calculate WDA. As it is main pool, it will be at 18%. So it will be 256,500 into 18%. This will be students 46,170 and this will be the allowance we can claim. So the balance will be students, the tax written down value carry forward will be minus 256,500 to 10330. I hope this is clear. So this is the allowance for the tax for the accounting period of 24 Jan till December 24. So the total is students, the total of this will be 1,059,770. 1,059,770. I hope this is clear. Now students, this is the capital allowance for the tax year. So capital allowance was 1,059,770. So this will be students taxable trading profit will be, the tax adjusted trading profit will be 461,000 pounds. Now we need to see for December 22. Now we need to see for December 22. So for December, for the next year student, December 25 from Jan. Now same students will be following the same format. We will be following the same format. Main pool, AIA, FYA, AIA and FYA, main pool, special pool, private asset pool, and then allowances here, and the last column will be students short life asset pool. So the tax written down value brought forward. So students, as we have seen, here, the written down value of main pool is this much. So main pool written down value is 210. So the written down value will be students, the written down value will be on main pool 210,330. Now additions qualifying for FIA or EIA, nothing we have purchased in the tax year of 24. See students, we have only purchased in the 24. In 25 we have not purchased anything. So no additions. Additions qualifying for, not qualifying for FIA and EIA, nothing is there. Any disposal, no disposal students. So after this we'll get the value of the pool, and on this pool we'll calculate the WDA at 18% as it is main pool. So it will be 37,859. So this is the allowance. So this will be in our allowance column. So the balance will be tax written down value carry forward will be students 172,471. This we can claim the allowance. So this students is the allowance for the tax year, not for the tax year, it is for accounting period from Jan to December. So it will be 37,859. So the tax adjusted trading profit will be students, the tax adjusted trading profit will be 1,487,141. I hope this is clear. Now this is as per accounting period students. This is as per the accounting period, and capital allowance is also calculated as per accounting period. Now this tax adjusted trading profit you need to see and calculate as per the basis of assessment rule, and for the tax year 23-24 you need to tax it till December 24. So only for the tax year 23-24 from April to December, and from 31st December, from 1st April to the 31st March. Remember the basis of assessment rule, tax year basis in previous chapter. Tax year basis, apportion, we need to apportion to which relevant month the income relates to as per the tax year. So for 23-24 we have transitional rules, but when we follow the 24-25 rule we will use the tax year basis rule students. I hope this is clear. But we have already studied in our previous chapter that the 22-23 tax year will be tested as the accounting period will be April to March only, or 5th 6th April to 5th April. The accounting period will be same as the tax year. So no issue in that. But we are seeing here different. But you need to have an understanding. Do not confuse between the accounting period and tax year, students. This amount then will use the tax basis. I hope it is clear. Now we'll be looking to further rules. Short or long period of accounts. As we have seen, students, short or long period of accounts, if the period of accounts are short or long, we will adjust the 1 million pound. We will adjust the 1 million pound. The AIA and WDA are given for period of accounts. That is the period for which a trader prepares accounts. So trader prepares the accounts. The 1 million maximum AIA and WDA percentage of 18% are based on period of accounts of 12 months period. That is 12 months. So here, students, have you noticed one point? Here when we calculate our WDA, that is 18%, it was purchased in May. So we need to only calculate for 8 months the WDA. But students, one important point in the capital allowance chapter when we are seeing is that the AIA and WDA are given on the period of accounts. They are given on the period of accounts. So on period of accounts, if they are given on the period of accounts, then the purchase date of the asset is irrelevant. Purchase date of asset will be irrelevant. Purchase date of the asset will be irrelevant. If you purchase at the end date, the whole 18% for the whole 12 months period, the allowance will be calculated. If you purchase at the start, also 12 months allowance will be calculated. So when coming to short and long period of accounts means 12 months for which accounting, this is accounting period for which the books are prepared. If they are more, then the AIA needs to be adjusted and the WDA percentage also needs to be adjusted. This WDA percentage is for 12 months. If my accounting period is for 14 months, students, so into 14 divided by 12, it will be, you need to use 21%. I hope this is clear. The first point. Short or long period of accounts result in the AIA and WDA being reduced or increased to reflect the length of the period of accounts. If the period of account exceeds 18 months, then it must be split into two capital allowance computation, 12-month period and a second year period to deal with the remaining months. The 12 months allowances are then, the total allowances are then deducted from the tax adjusted profits of the long period. So students, this point says that, this point here mentions that if our accounting period is more than 8 months, exceeds 8 months, then it must be split into two capital allowance computation, a 12-month period and a second period to deal with the remaining months. If it is less than 12 months, students, if it is less than 18 months, if it is less than 18 months, students, it will be calculated as per the normal rule. We'll increase it 12 into 18. But if it exceeds 18, if the period of account exceeds 18 months, then first 12 months separate and the rest months will be calculated as separate. I hope this is clear. If the accounting period exceeds 18 months, first 12 months will be calculated separate and the rest month will also be calculated as separate computation. But when we adjust for our tax, for the tax purpose, we will take the total allowances, the 12 months and the next further months calculation. I hope this point is clear. If the accounting period is 18 months, then we'll increase the AIA and WDA. If the period of account is more than 18 months, the capital allowance needs to be split into two parts, first 12 months and the rest months. Let's take an example of 20 months. So it is more than 18 months, first 12 months and next 8 months cap. But when we claim our capital allowance, we need to add it. both capital allowance of 12 months and 8 months need to be added together to adjust to the accounting profits so that we arrive to our tax adjusted profits. The most common occasion for a business not having a 12 months period of account is at the start of the trading. Means when they start, they can either prepare the accounts for 12 months, 24 months, 8 months, etc. Remember that FIAs are never adjusted to reflect the length of period of account. So students, only AIA and WDA will be adjusted as per the length of accounting period. If the length of accounting period exceeds 18 months, then 12 months separate computation and the rest months separate computation. But these two needs to be added to claim the capital allowance and adjust to the accounting profit so that we arrive at our tax adjusted trading profit. I hope this is clear. Now we will be solving a question so that we have a better understanding. As we have already solved it, but we will be solving further. Short or long period of accounts. X commenced trading on 1st April 2023. They prepared accounts for 14 months period ended 31st May. So students, 14 months period they have been preparing the accounting books. So capital allowance will be based on accounting period. So 14 months and year ended 31st May on 2025. On 1st June 2023, they bought plant and machinery for 1,100,000. A new car with CO2 emission of 46 gram per kilometer for 19,800 pounds and a new zero emission car for 13,000. Calculate X capital allowance for each of the period of trading, assuming that the tax year 23-20 rules applies throughout. This assumption is, students, of the previous chapter we have learned. It's an assumption. But in your examination, the accounting period will be ended 31st March or 5th April. Please do clear in mind. Now capital allowance, students. The accounting period is for 14 months. The accounting books is prepared for 14 months, trading on 1st April. So from 1st April ended is 31st May. So the period of account 31st May, 14 months. So 31st May. So April 23 to 31st May 24. This is 14 months period. Now FIA, AIA, main pool, private pool, short life asset pool, special rate pool. I hope this is clear. Now tax written down value brought forward. No, because we are commencing the trade just now. So this will be, students, 14 months calculation. On 1st June 2020, they brought plant and machinery for, this will qualify under main pool. New car with 46 main pool, 0 FIA. I hope this is clear, student. Now additions qualifying for FIA and AIA. So for FIA we have 0 CO2 emission car, that is whole 100% will claim 13,000 pounds. Allowance column. Then AIA. For AIA we have plant and machinery, that is 1,100,000. I hope this is clear, students. Now AIA limit, we can claim AIA up to, for each 12 months accounting period, That is for each 12 months accounting period. But here students, our accounting period is for 14 months, and for 14 months we need to increase the limit. We need to increase the limit. For FIA will not increase it. For AIA we need to increase the limit. The limit now will be 1 million into 12 divided into 14 divided by 12. This will be students into 14 divided by 12 divided by 12 into 14. It will be 116666, and this is within the limit, so the full amount will qualify for AIA. I hope this is clear, students. Now additions not qualifying for FIA and AIA, that is car of CO2 emission of 46 gram per kilometer. That will be students under the main pool. The cost was 6,000. The original cost was 19,800. Sorry, 19,800. So now any disposals? No disposals, students. So no disposals. Now we will be no disposal. So students, the total of the column will be, now we need to see WDA. WDA will be calculated brought forward balance plus additions which do not qualify for FIA and AIA, and excess, no excess amount. So this will be 19,800 at WD at 18%. This will be 19,800 into 18%. Students, you need to remember one point. That is short or long period of account. This we need to increase it. Do not do this mistake. So 14 divided by 12, 18% into 14 divided by 12. This will be 21%. We need to get, so 19,800 into 21% will be 4,158 WDA. This will fall under the allowance column now, so that we can claim the total allowance. Now tax written down value carry forward will be, students, 19,800 minus 4,158 will be 15,642. I hope this is clear. Either you can calculate 80% for 12 months and increase it, or either you increase the percentage only. I hope this is clear, students. For long and short period of account, we need to see the AIA limit and WDA percentage, because capital allowance is calculated as per the period of accounts, and the AIA limit is only for 12 months and the WDA percentage is also for 12 months. See students, we have already seen here the 18% is for 12 months period, and the 1 million pound of AIA will also for 12 months period, and this needs to be increased. And we have already seen here for the AIA and WDA percentage are for based on period of accounts, that of 12 months. So if the period of account is more, we need to claim more. Either you can increase the percentage, students, or you can claim 18% divided by 12 into 14. If you do, you will get the same answer. 18,900, students, into 18% will be 3,564 divided by 12 months into 14 divided by 12, 4158. Same. Follow this method only, students. It will be easy. Doing the percentage, it will be confusing. Follow this. If the AIA and WDA, the period of account is short, we need to adjust and increase and decrease as per the period of accounts. I hope this is clear. Now this, the total of the allowance will be, students, 13,000 plus the AIA plus 4,158 it will be 1117158. I hope this is clear. March, it is for May 2024. Now students, for 31st May, as we have seen, we have not purchased any asset. And student, here keep one mind, it is 1st June 2023. Now we have calculated the WDA for whole 14 months, but we have purchased the asset. The asset has not been used for the whole 14 months. In calculation of capital allowance, the date of purchase is irrelevant. The date of purchase is irrelevant. Please do keep in mind. But when we calculate the depreciation, students, when we calculate the depreciation, the asset was purchased midway, we only calculate 6 months depreciation. But for capital allowance, if the asset is purchased at the last date also or at the first date, for the whole accounting period, the whole period of account, the capital allowance will be calculated. Now we need to for 31st May 2025 also. Now students, directly we can here also, year ended 31st May 25. No, this will be brought forward balance down, and students, no addition, no disposal were there, no AI. So directly the WDA will be calculated on this amount. So WDA at 18% into, that is 15,642 into 18% into 14 divided by 12. This will give you figure of 2,816. So if reducing by this, the value will be 12,826 students. This will be the allowance for 31st May 25 from. I hope this is clear, students. This will be exact 12 months now. So no, May, April, after May, June. So till June to May. So it is 12 months period only. So no need of apportioning it, because it is only for 12 months. Exactly the period of accounts is for 12 months. 15,642 into 18%, that is 12,860. By reducing, will get our tag written down value carry forward. I hope by solving this question we are clear with the short and long accounting period rules. Short and long accounting period, what it will affect, students? The WDA percentage and the WDA amount and the AIA limit, we need to increase or decrease as per the period of accounts. The FIA will not depend on the shorter period, long period of accounts. And one more period, the date of purchase is irrelevant. The capital allowance will be calculated for the whole period of accounts. Now moving to the next topic, length of ownership in the period of account, students. The length of ownership in the period of account, that is ownership of the asset. It is important to distinguish between the length of period of account and the length of ownership of the asset. Length of period of account means the accounting period, and length of ownership of the asset means the asset when we have purchased and for how long we hold that asset, the ownership. The accounting period can be 12 months, but the ownership will be 12 months. We have purchased after 4 months. The WDA is applied proportionately according to the length of period of accounts. So the WDA is applied length of period of accounts. The WDA is never restricted by reference to the length of ownership of an asset in the period of accounts. So students, we will not consider the length of ownership, in the period of accounts. We will consider the length of period of accounts. If a business prepares accounts for the year ended 31st March 2024, the same WDA is given whether an asset is purchased on 10th April 2023 or on 31st March 2024. The WDA is available provided the asset is owned on the last day of the period of account. The actual length of ownership of the asset during the period of account is not relevant. So already mentioned by me, the length of ownership is not relevant, the length of period of account will be relevant, and the WDA will only be calculated if the asset is available at the end. The asset is owned at the last day of the period of accounts. Period of accounts means accounting period. I hope this is clear. The length of ownership is clear. Now students, now we will be seeing the sale of plant and machinery. In our format students, we have already seen the disposal part. Now we will be studying the disposal part. Disposal proceeds, how it will be get. This disposal of 130 and 50 is for the companies. When we will study the companies, we will be studying under the Companies Act, no issues. Now we will be seeing for the individuals. Sale of plant and machinery students. When sale of plant and machinery will reduce the pool's value, we have studied in beginning students, if any addition will increase the pool value, if any disposal will reduce the pool value. When an asset is sold or scrapped, the following steps are taken. The disposal value, so the disposal value will be students lower of two things, lower of sale proceeds and original cost. So students, the disposal proceeds will be lower of two things. The disposal proceeds will be lower of sale proceeds and original cost, is deducted from the total of tax written down value brought forward on the pool plus addition to the pool, additions not qualifying for either the AIA or FIA and additions qualifying but not covered by the AIA limit. I hope the first point is clear students. It is very simple. See, first tax written down value, then any additions qualifying for AIA, additions not qualifying for AIA, then disposal. This disposal will be reduced from which value? The tax written down value. Additions qualifying for AIA, it will directly go to allowance, and additions which are qualifying for AIA but excess of the limit will then be shifted to the pool, irrespective pool. Then AIA, additions not qualifying for AIA will be in the pool, either main pool or special rate pool. Now after this will give you the total. From this total will reduce the disposal value, and the disposal will be students lower of sale proceeds and original cost is deducted from the total of tax written down value plus tax written down value plus the addition to the pool not qualifying either for AIA and additions not qualifying, addition qualifying but excess of the AIA limit. After these total will reduce the disposal, and this disposal will be lower of two things, original cost and sales proceeds. The WDA for this period is then calculated on the remaining figures. After the disposal only we will calculate the WDA. After the disposal value we will calculate the WDA. Capital loans will be calculated. If sale proceeds exceeds the original cost of the asset, the disposal value deducted from the pool is restricted to the original cost, that is lower of sale proceeds or original cost. Note that any excess of the sale proceeds over original cost may then be taxed as chargeable gains. See later, we will be seeing this under capital gain tax. I hope this is clear. The disposal will be lower of two things students, lower of disposal proceeds or original cost. After the disposal value, we will be calculating the WDA. Therefore, on disposal, always deduct from the correct pool the lower of sale proceeds and original cost. So, lower of these two items we need to cover. So, in sale of plant and machinery students, we need to keep only two things, lower of disposal proceeds or original cost. this we will reduce, and after the reduction amount, we on that amount will calculate the WDA, written down allowance, or writing down allowance. Now we will be seeing one case, one example. G prepares accounts on 31st May. So prepares 31st May each year. In the year to 31st May 2024, the following transaction took place. 5th June 2023, plant sold for 1200, purchase for 8000. 3rd September 2023, plant purchase for 204,000 pounds. Compute the capital allowance for the tax year ended 31st May 2004, assuming that the tax written down value on 1st June 2023 was 10,000. Assume that tax years 2023-24 rule applies throughout. So here students, FIA, AIA, then main pool, special pool, private pool, short life asset pool, then allowance column. Now students, the accounting period is from June 2023 to 31st May 24. This is for 12 months period. So no short or long term period will come into picture here. The limit and the percentage will be remain the same. So now tax written down value brought forward, that is students, was 10,000. So nothing is mentioned, means it is main pool, general pool. Then additions qualifying for AIA, and students, AIA is available for each 12 months period. So they have purchased a plant, so this will qualify students. So AIA, as no FIA, no car is there, AIA and FIA, AIA will be available for AIA on plant, that is 204. The AIA limit is within the limit, so 204 full amount will be the allowance column. As will not increase the our limit because it is 12 months accounting period. Now additions not qualifying. And AIA. I hope this is clear students. As we have nothing, here it is 204. Now students, after this, any disposals? Disposals we have disposal of plant sold for 12,200, purchased for 8,000. So disposal will be lower of two things students. Lower of disposal proceeds, DP, or original cost. So original cost is 8,000 pounds and DP is 12,000 pounds. So it will be 12,000 pounds. So we'll reduce from the main pool, as plant belongs to main pool. So this will give to the total of balance of remaining balance of students 8,800. Now on this we will calculate the WDA. WDA 18% at its 12 months accounting period, no issue. So it will be 8,800 into 18%, 1,584. The tax written down value carry forward will be students 7,216. This 1,584 will be in the allowance column. So the total allowance will be students the total will be 205,584. This is the allowance we can claim. I hope this is clear students. The disposal will always be at lower of two things, and the disposal will be reduced on the pool from which the asset has been sold. Now moving to the balancing charge and cessation of trade. So students, first we have seen the AIA, then we covered FIA, then we covered WDA. These are the types of allowances, and we have seen that for which asset it will be available. AAA will be available for all, WDA will also be available to main pool, special pool, and main pool and other pools also. Then we have studied the short term or long term period. Then we covered length of ownership of the asset and length of the period of accounts. The length of period of account is important. The length of ownership is not important. It will be irrelevant. Either the asset is purchased on 10th April or 31st March at the end. The WDA will be available for the whole period of accounts. That is the period of accounts, but the asset must be available on the or purchased on the last day of the period of account. The period of account, dear students, is 31st March 2024. So 31st March we need to own that asset. I hope it is clear. Then we have seen sale of plant and machinery. Sale of plant and machinery will occur at lower of two things. Lower of two things is sale proceeds and original cost, students. Now coming to balancing adjustment. Balancing adjustment. It is very easy, students. Balancing adjustments, we have two types: balancing charge and balancing allowance. First, we'll be covering balancing charge. When does balancing charge occurs? Initially, the asset is put into the pool at its original cost. Yes, the asset is put into the pool at its original cost. If on disposal of any asset in the pool, sale proceeds exceed the balance brought down. So, students, initially the asset is put into the pool at its original cost. If on disposal of any asset in the pool, sale proceed exceeds the balance brought forward, it will create balancing charge. That is, students, let's take an example. 10,000 pounds. We had claimed the capital allowance, and our tax written down value will be 2,000 pounds, students. And now we are disposing it. We are disposing the asset. Disposal of the asset. Disposal of the asset, students. The disposal of the asset. Now, when we dispose the asset, students, disposal proceeds will be lower of two things: original cost and sales proceeds. Original cost and sales proceeds. So lower of two things. Original cost is 10,000 and sales proceed is 3,000, but the value is only 2,000, students. So the disposal will be writing here 3,000. It will give us negative figure. This negative figure is known as balancing charge. Now we will be seeing how we will be dealing with balancing charge. The pool balance will become negative, as we have seen in our case. We have seen, students. Now disposal, lower of original cost or DP. This is original cost is 10,000, lower is 3,000. So disposal will be lower. So negative 1,000. The pool balance will become negative because allowance exceeding net cost have been claimed in the past. So what does this, students, means? The allowance has been claimed excess in respect of the original cost. So this 1,000 will be an income, students. We need to claim only 2,000, but we have claimed 3,000 through disposal also. So the allowance exceeds the net cost. The allowance which we have claimed exceeds the net cost. So this minus figure means we have claimed more allowance exceeding the cost. So we are getting the minus figure, and this negative figure will be an income, students. This negative figure will be an income, and this in the allowance column will reduce the allowance. Now capital allowance was 2,000 in this year. This will reduce the allowance, and we can only claim 1,000 allowance. If we do not have any allowance, this minus 1000 will add to the profit, tax adjusted trading profit. I hope this is clear. I hope this point is clear, students. The negative amount excess allowance previously given, these will be recovered and charged to tax by means of balancing charge. The balancing charge reduces the capital allowance claim for the period. If there is an overall net BC, that is balancing charge, it is added to the tax adjusted trading profit. Students, when we adjust a tax adjusted trading profit, we less capital allowance. But if we have a BC in net, that is balancing allowance in net, if we have balancing allowance in net, it will be added. It will be added. I hope it is clear. If we have some capital allowance claimed in that period, then the minus figure will reduce the capital allowance. No issue. If no capital allowance, directly we have minus 1000 as the figure. This will be added to the tax adjusted trading profit. Now we will solve a question so that we are clear with the concept. Balancing charge, students. G has traded for many years as an ice cream manufacturer. He prepares account to 30th June and during the year ended 30th June 2024. So student, the year ended is 30th June 2024. 14 July 2023 sold some machinery for 12,100 which originally cost 26,000. 30th August 2023 purchased a new zero emission cars for 14,000 pounds. 16th March 2024 purchased some equipment for 23,500. The tax written down value at 31st July 2023 was 11,000. Calculate G's capital allowance for the year ended 30th June 2024. Explain what would have happened had G made no addition in the year. We need to see in two cases. Now students, FIA, AIA, main pool, special pool, private pool, short life asset pool and allowance column. Now tax written down value brought forward, students, is 11,000. It will be main pool, nothing is mentioned. As it is mentioned here, sir, equity, it is for business use. Then additions qualifying for FIA and AIA. Sold and purchased a new zero emission cars. So FIA will be available of 14,000. So under the allowance column 14. Now AIA, students. AIA. Oh, on 1st July they sold. First addition, the addition is purchase of some equipment. 16th March. So equipment. It will be, students, 23,500. So it will qualify for this purpose. And the AIA limit for this year will be whole. It will be of whole, students. It will be of the whole amount. I hope this is clear. So the allowance will be 23,500 as the cost was. Now coming to additions not qualifying, FIA and AIA. Do we have anything, students? Nothing has been mentioned here. Sold, purchase, this also we have treated. So no. Then disposals. Do we have disposals? See, disposals. Yeah, sold one machinery for which cost originally 26,000. So we have sold the machinery which we have cost more. So students, disposal will be lower of two things. DP, disposal proceeds, or original cost. Original cost is 26,000 and students, the disposal proceeds was 12,000 and 100. The lower is this, so this will reduce the pool balance as we have disposed it. So if we get this, if we reduce the amount, we will be getting 1000 in negative. Now this means, what is this, student? This is balancing charge, because we have claimed excess allowances. We have claimed excess allowance. So no need for WDA, because it is balancing charge. So this will reduce the capital allowance. Already we have capital allowance, we have claimed it. So the capital allowance for the year will be, students, nothing. Then TWD, carry forward, nothing. Then allowance, the total allowance column will be, students, this will give rise to the total allowance of 36,400. I hope this is clear. When does balancing charge occurs? Balancing charge occurs when we are generating an profit. I hope it is clear. The pool balance will become negative because allowance exceeding net cost have been claimed in the past. If the balancing allowance we are getting, it will be negative figure. It will reduce the capital allowance. If we have overall net balancing charge, it will be added to the tax adjusted trading profit. I hope this is clear, students. As we have seen, the disposal will always be at lower of sale proceeds or cost. This disposal value is more than the balance in the pool. Then balancing charge will occur. Now students, we need to the case number B. Explain what would have happened had G made no addition in the year. If G had no additions, means they have not purchased the zero emission car, and this they have not purchased. And student, one more point, the length of period of account is important. Length of ownership is not important. Now coming to the B case. When we come to the case of B, students, same format will draw. FIA, AIA, main pool, special pool, short life asset pool, private use pool, allowance. This is clear. Now TWDB brought forward. This will be, students, as we have already seen, we have a brought down balance of 11,000 in the main pool. Any additions? No additions, students. Disposal? Yeah, we have disposal, lower of DP, original cost and DP. Now students, DP is 12,100, original cost is 26,000, so lower is 12,100. So this will be figure of negative 1,100, no WDA. So students, this amount will reduce the capital allowance, but no capital allowance is available. So when carry forward balance, then allowance. So students, the net allowance we have in minus. If we have in overall net BC minus overall net BC, we have here balancing charge net. So it will be added to the, so this amount will be added, students, it will be added to trading profits, the accounting profits. Let's write accounting profits, because we have seen in a previous chapter, add to accounting profits to arrive to tax adjusted trading profit. I hope this is clear, students. This point is clear. When does the balancing charge arises? Balancing charge arises, students, when we sell the item where the disposal proceeds is greater than the balance in the pool. Sale proceed exceeds the balance brought forward. Sales proceed exceeds the balance brought forward. Now students, we will be seeing the cessation of trade when we close our business. So students, we have already seen that when the business is permanently discontinued, then AIA, WDA and FIA will not be available. We have already covered here students. See here, the WDA will not be available in the cessation. FIA will not be given in the final period of trading, and AIA will also not be given, not available in the period of accounts. So all these three allowance will not be provided in the period of accounts, that is accounting period, when we close our business. When the business is permanently discontinued, the AIA, WDA and FIA are not available in the final period of accounts. A normal capital allowance computation is therefore not prepared for the final period to the date of the cessation. So normal computation will not be followed. Instead, the following steps should be followed. Add in any addition made in the final period. So any addition will add to the respective pool, but no AIA will be available. Do not calculate any AIA, WDA or FIA. So let's take students the tax written down value brought forward in main pool, special pool, and the rest two pool will be same. So let's take, we have here, and this year we are, this period is from Jan to December, we are ceasing our business. So any addition, we have purchased a car of CO2 emission 43. So this will increase of £1000. Do not calculate any AI or WDA. Deduct any disposal made in the final period and any sale proceeds on the ultimate disposal of the plant and machinery at cessation. So after this disposal, now we need to consider the disposal of all the items, whether disposal was that, and when we are cessation, when we are doing when we are closing our business, we will be disposing of the assets. So disposal on those assets also we need to calculate. Calculation on the disposal will get some amount. Calculate will bring a balancing charge, whether we'll have a minus figure. As above, we have already seen if minus figures come, how we'll be dealing it, or balancing allowance as appropriate. See below. There should not be any balance carry forward at the end of the trade. So students, if we have a minus figure, this will be taken to the allowance columns. This will be the net BC. So it will add to the accounting profit when calculating a tax adjusted trading profit. But students, in our example, additions, car CO2 of 43,000 pounds, disposal we have already done. So after the calculation of disposal, students, the disposal value was, let's take 8,000. So this will give rise to a figure of 3,000. So if we have negative figure, students, here it will be balancing charge. But here we have, students, here balancing allowance. It is a positive figure because 11,000 minus 8,000, it will be 3,000 positive. It will be 3,000. This will be balancing allowance. So students, at cessation, if there is still a balance of unrelieved expenditure in the pool, business can claim relief for the unrelieved balance by the way of obtaining balancing allowance. This is only time a balancing allowance will rise in main or special pool items. So students, balancing allowance, when it will arise, students, balancing allowance will rise when we close our business, in the main pool or special pool. So this 3,000 whole, the balance allowance is the excess of the pool at the end of the final period of the account over the sale proceeds received on all disposal. After all disposal also we have further amount. If it is minus, it will be balancing charge. If it is positive, it is with balancing charge, balancing allowance, including on the ultimate disposal of the plant and machine. So this whole 3,000 we can claim allowance as balancing allowances. So the figure must be 0, students. At last, what does the cessation state? whatever pool you have, if after disposal you are having some value, let's take 3000 in our case, this must be to 0. So this, excuse me, this we will take to the allowance column, students. It will be treated as balancing allowances. So students, we have balancing charge and balancing allowance. Balancing charge occurs when the proceeds exceeds the total value of the column after the disposal, but balancing allowance will only come when we have disposed of all the assets and we are closing our business. If we have any positive figure left in the balance in the pool after deducting the disposal, we can't claim WDA because we are closing our business. During our cessation, we will not be able to claim AIA, WDA, FIA. So this amount directly will shift to the allowance column. So this will known as balancing allowance, and balancing allowance will only arrive during cessation. I hope this point is clear, students. The balancing charge and balancing allowance, these two topics are also very important, students. The balancing allowance and balancing charge. I hope this point is clear. Now students, we will be doing a question on cessation of trade. G has previously prepared accounts to 31st March. He decided to cease to trade on 31st December 2024. Okay. After a period of ill health, the following transactions have recently taken place. So 31st March is our accounting period. It will be in line with tax year as per our new tax year 23-24. So 21st of February 2024, they sold 350, original costing this much amount plant. 10/9/2014 they purchased 4000. On the completion of the sale of his business, G received 5400 from his plant and machinery. No item was sold for more than its original cost. The tax written down value on 1st April was 9000. So students, the tax written down value is, they have provided us the tax written down value is 9000. This will be only for the main pool. Compute the capital allowance for the year ended 31st March and the period ending. Okay, we need to calculate for both. So both we need to calculate. Then we can't take 1 minute, students. So 31st March 24. So tax written down value. So FIA and AIA, main pool, special pool, private use, short life asset pool, and allowance column. This format is clear, students. Now we are starting from 1st April 2023. So 1st April 2023, the written down value was 9000. I hope this is clear, students. Now 21st to 2024 plant was sold. So this is belonging to next accounting period. So in this tax year, no addition, students. Additions. Now disposal, we have only disposal. So the disposal will be, students, sold for 320, purchase was 2000. So disposal will be lower of two things, DP and original cost. Original cost is 2000, DP is 320. So this will reduce the balance, students. So this will give rise to the 8680. Now WDA, add 18% and it is for 12 months period, so no need to apportion. So this will be 1562 allowance. This will give rise to the tax written down value carry forward of 7118. The allowance will be total, students, 1562 for the accounting period of 1st April to 23 to 31st 31st March 23, 24, sorry. I hope they now from 31st April 20 no 31st 1st April 24, the tax written down value will be, students, 7118. Main pool FIA, AIA, special pool, private use pool, short life asset pool, and allowance. This is clear now. This is the tax written down value brought forward, sorry, this carry forward will become the brought forward, so it will be now any additions, students, we have purchased on the on 10th 9 2024, that is before the 2 to 3 months of the cessation. We have purchased 4,000. This 4,000 will qualify for AIA, students, and for each accounting period it will be for 12 months. But student, AIA will be available not? But student, AIA will not be available because we are seizing the trade. When we are seizing the trade, AIA, WDA and FIA will not be available in the final period of accounts. The final period of accounts is prepared from 1st April to 31st December 24. So AIA will not be available. So directly we'll add it to the pool. Now this will give rise to the total of, students, 11,118. Now any disposal, students? We have been said that the disposal, when we seize our business, will receive the 5,400 for his plant and machinery. So 5,400 disposal. As we are seizing, when we seize at market, we are seizing and we are receiving the disposal proceeds. So it will be 5,400. So students, you can't take your cost because everything is included here. So this will give rise to an amount of lower of cost and disposal proceeds. DP was this much, students. Disposal proceeds were 5,400 and cost were, we have already seen, 4,000, and by previous cost also we need to include it. So the lower will be the disposal, as when we seize our business, students, deduct any disposal made in the final period, no disposal, any sale proceeds on the ultimate disposal of the plant and machinery at cessation. When we, on the completion of the sale of business, G received. So this is on the sale of his business, so it will be disposable, and the disposal proceed cannot exceed the cost. So this will give rise to a figure of 5718, students. Can we claim WDA? No, students, as we have closed our business, so this will be treated as balancing allowance. So under the allowance column, 5,780 will be your total allowance. I hope this is clear. If we had a negative figure, it would be balancing allowance, and this balancing allowance would have been added to the trading profit, accounting profit, to arrive to a tax adjusted trading profit. But here we have balancing allowance, and balancing allowance only arrives on the cessation in case of special pool and main pool. In case of special pool and main pool, only on cessation you will arrive with your balancing allowance. I hope this is clear, students. This is clear. I hope this point is clear. Now, students, we have further few topics to cover, like the asset with private use by the car of the business, then the private use pool, special rate pool, short life asset pool, and structure and building allowance will be covering in our next class. But Today's last topic will be the car. We have already covered this topic, but we are taking a brief summary. The treatment of cars depends on the CO2 emission as follows: 0 CO2 if purchased new, FIA full 100%. If purchased second hand cars like hybrid cars, then main pool students. If 1 to 50 grams included in the main pool as an addition and not qualify for AIA or FIA, more than 50 it will be included in the special rate pool as an addition, not qualifying for AIA or FIA. The FIA and WDA percentage applicable to the different CO2 emissions are included in the rates and allowance provided to you in the examination. That is the note, however, that cars with an element of private use by the owner of the business, regardless of the level of emission, are dealt with separately under private will be seen. So students, private use only will come into picture when the owner is using. If the employee is using, it will not come into picture. So if the owner uses, it will come under the head of private use asset. We'll cover in our next class. Remember that AI is not available on the any type of cars. So now we'll be solving a question relating to cars. G prepares accounts to 31st March. At 1st April 2023, the tax written down value. So we need to prepare the format: FIA, AIA, main pool, special pool, private use pool, short life asset pool, and allowances. So it will be for the year ended 31st March 24. This. So the tax written down value is, students, brought forward is, the main pool is 21,200. The following transaction took place during the 2 years ended 31st March 2025. So for 2 accounting period, the following transaction took place. 25/4/2003, purchase a car with CO2 emission of 49. So students, for the year 24, that is from 1st April 23, we have purchased a CO2 emission car. So additions and purchase plant and machinery for 11,000. 15/8/2024, this will be in the next accounting period, sole equipment at original cost. So calculate the capital allowance for the 2 years to 31st March 25, assuming the tax year of 23-24 rules applies throughout. So students, after this, any additions qualifying for FIA or AIA? We have purchased, dear students, a car with CO2 emission. So it will be main pool, so it will not qualify for FIA. But purchase plant and machinery on 11/6/2024. So 11/6/2024, it will be in the next year, students. So this, no additions. So additions not qualifying for FIA, we do not have additions. Not qualifying for, we have it, that is car of CO2 emission of, students, 49. So it will be covered under the main pool, that is 20,600. This will be give total of 41,800, and we have no disposal in the next accounting period, students. Please do keep in mind. Now we will calculate WDA at 18%. It is 12 months accounting period, no issues. So this will be 7,524. So the tax written down value carry forward will be, students, 34,276, and this will move to the allowance column. So the allowance, so the total allowance will be, students, 7,524 for the accounting period of 1st April 23 to 31st March 24. Now students, moving to year ended 31st March 25. FIA, AIA, main pool, special pool, private use pool, special short life asset pool and allowances. Now students, the tax written down value brought forward will be last year's closing balance. Carry forward was 34,276. It was 34,276. Any addition students? Please do remember we had purchased a plant. So it will be additions qualifying for FIA or AIA. So plant we had purchased for 11,000. This will qualify for AIA students. So the AIA will be 11,000 within the limit. So in our allowance column it will be 11,000. I hope this is clear students. Then after additions not qualifying. We have only two purchasers. One was relating to car, that was for previous year, and no additions. Now we have a disposal. Disposal will be at lower of two things students. Lower of cost or DP. So students, original purchase was 15,000 and equipment sold for 9,400. So the disposal proceeds is only lower. So disposal original cost disposal proceed is of 9,400 students. So this will give rise to the balance of 24,876 and we'll calculate the WDA because we are not ceasing the trade at 18%. The accounting period is same 12 months. No need for short or long accounting period adjustment. So it will be 4,478 students. So this will give rise to the tax written down value carry forward of 20,398. Excuse me, the written down value is 4,780 and students the total allowance will be 11,000 plus 4,478, 15,478. I hope by solving this question we are clear with the cars part. Now students, we have few topics left by the special rate pool, short life asset pool and private use pool, and we have structure and building allowance. So students, we have completed the main pool. The completion of main pool we have completed, and now this topic will be very easy. If you understand the main pool, these are just a piece of cake, very easy, the same rules, because students we have two main pools, main pool and special rate pool. But the private use pool is different. Each asset you use private, you will be creating each pool, a separate pool. For car, then other car, for other car also you will be creating. So car will belong to main or special pool, the same WDA will be applicable. And then short life asset, the asset with short life. So the same rules like the main pool will be applying, the FIA, WDA, all things. Now, and the last topic, structure and building allowance, will be covering in a next session. I hope today's class was interesting and good. If you have any doubts, please do message in the WhatsApp group so that your query gets solved. So in our next session, we'll be completing the rest 4 topics. With this will lead to the completion of this chapter. So I hope the chapter was interesting students, the capital allowance, and today's session was good. Goodbye. Have a good day.